Welcome everyone to this panel discussion on central banks and inequality. We're going to base this discussion around two big questions. One is on monetary policy and inequality, and then a second topic around the role of central banks in addressing diversity and inclusion, not just in their institutions, but also more widely in the economics profession. We have a terrific set of panelists. We have Roger Ferguson, who's a former vice chair of the Federal Reserve Board, Nellie Lang, who is the Undersecretary for Domestic Finance from the US Treasury, Isabel Schnabel, who's board member at the European Central Bank, and I believe we are still waiting for Governor Andrew Bailey from the Bank of England to connect. But I think we should start. So again, we start with the first topic, which is about monetary policy and inequality. This gets a lot of attention because we see lower interest rates associated with big increases in asset prices, which benefit the wealthy. And that certainly triggers alarm that monetary policy can generate an increase in inequality. Now, of course, to make a conclusion on this, you need to dig into all the other things that monetary policy does. And we've looked at this at the IMF. And then one of the channels through which monetary policy, of course, affects the economy is when you have lower rates, you're creating more employment. And we know that recessions are times when it is low-income workers who tend to lose their jobs. So stimulus and monetary policy has the benefit of bringing back low-income workers, giving them, making jobs available, and therefore helps the lower end of the income distribution. Similarly, by keeping interest rates low, borrowing costs are also lower, and the low income tend to be the ones who borrow. And so again, that helps in that dimension. So when you look at the multiple ways monetary policy affects the economy, one of the, you end up, at least in the analysis that we've done, with the view that it has mostly not much of a significant effect on inequality because there are benefits and then there are costs. So in that sense, there is an argument for monetary policy to stay focused on its job of macro stabilization within its mandate, be it the price mandate or more.
This is Bank of England. Are you able to hear me and see me?
Flexible mandate. I believe, yes, we are. Yes. Okay, so with that interruption, going back, so I guess that's where we are. It seems like for inequality, it's important to have a role for fiscal policy and structural reforms in addressing inequality, and monetary policy may not be the right toolbox for this. But again, this is not a closed question, and that's why we're having this panel discussion. So I'm going to now pose the question to the panel, which is basically how should central banks take into account economic and social inequality when considering monetary policy? What do you think is within the scope of central bank's current mandate? And what would you say to those who would want those mandates to be changed? And in terms of, would call on the panelists to give about 5 minutes each on their remarks. And in terms of the order of speakers, it will first be Isabel Schnabel, then Nellie Lang, then Roger Ferguson, and then Andrew Bailey. So Isabel, the screen is yours, and you have 5 minutes.
Thank you very much, Geeta, for the introduction, and thank you very much for having me on this great panel. It's a true pleasure to be here, and certainly the topic of our panel today is highly topical. We know that income and wealth inequality have increased in many countries over the past decades, and two main factors can explain this longer-term trend. So one is increasingly skill-biased technological change, and the other is the gradual erosion of workers' wage bargaining power. It is less clear, as you, Gita, also mentioned, how monetary policy may affect the distribution of income and wealth. So it's certainly well documented that by protecting the purchasing power of people, monetary policy can contribute to reducing income inequality. And the reason is that inflation is actually one of the most regressive taxes. But monetary policy may also reduce income inequality in the way it transmits through the economy. Next slide, please. So as illustrated on the left-hand side of my first slide, research shows that households with lower incomes tend to have on average the highest risk of losing employment during a recession, as Gita also mentioned in her introduction. And this means that the stimulative effects of monetary policy easing on aggregate demand tend to protect the most vulnerable members of society. And this was also the case during the pandemic. The right-hand chart reminds us that the global financial crisis of 2008-9 primarily hurt younger and less skilled workers with significant risks of permanent scarring. And there's broad consensus that the central bank's pandemic measures, including the ECB's pandemic emergency purchase program, have prevented a collapse of the financial system this time, which at the same time then reduced the pandemic's impact on inequality. New research, however, suggests that the effects of monetary policy are more nuanced when also considering realized capital gains, which are typically not included in official measures of personal income. In Sweden, for example, the effects of monetary policy have been found to be U-shaped because capital gains often constitute a larger share of total income for those at the top of the income distribution. And evidence from Denmark even suggests that households with the highest incomes tend to benefit the most from lower interest rates. And these findings suggest that the distribution of net wealth plays an important role in the overall picture. And this asset price channel is likely to have become more important over time. Next slide, please. So faced with the lower bound, many central banks have increasingly resorted to asset purchases. And as shown on this slide, the ECB has bought bonds worth more than 4.5 trillion euros since late 2014, or nearly 40% of pre-pandemic GDP. And such purchases were certainly necessary for central banks to fulfill their statutory mandates. But since they directly affect the prices of longer dated assets, their impact on relative incomes and wealth may be more pronounced than that of changes in short-term policy rates. And I would like to distinguish two types of effects, direct and indirect. So the direct effect relates to the capital gains that accrue to the holders of securities because of our purchases. And these benefits tend to be highly concentrated. So the right-hand chart shows that in the euro area, less than 1% of households in the bottom net wealth quintile hold bonds, mutual funds, and stocks, while a significant share in the top decile hold such assets. Hence, central banks purchasing longer dated assets disproportionately benefit wealthier households. The indirect effects relate to the portfolio rebalancing triggered by the compression of risk-free interest rates. Faced with low and falling yields, many institutional investors have purchased residential and commercial real estate even well before the pandemic. Next slide, please. So the left chart on this slide shows that, for example, in the Netherlands, real estate investment trusts owned assets worth almost 10% of the country's GDP in 2018. And research by the IMF has found that such investors are likely to have played a role in pushing up global real estate prices in recent years. As a result, house prices are increasingly behaving like globally traded financial assets, and therefore they risk diverging from national income developments. And this is shown on the right-hand chart. There you can see that in the euro area, residential property prices have risen by 35% since 2015, and this is much faster than disposable income. So my final slide, please. And new ECB research corroborates these findings. It suggests that unconventional monetary policy measures, such as asset purchases, are likely to have a significantly larger impact on house prices than changes in short-term policy rates. And in countries where home ownership rates have traditionally been high, such as Spain and Italy, house price increases generally benefit a large share of the population. But in other countries like Germany and Austria, where less than half of the population own their main residence, the recent sharp increase in house prices could heighten inequality. And this was actually a concern raised frequently at our ECB Listens events. So the question is, what does this now imply for our monetary policy? So first, central bank must pay more attention to house prices. As part of our monetary policy strategy review, we recommended a roadmap for the inclusion of owner-occupied housing in our inflation index. The right-hand chart shows that the inclusion of owner-occupied housing costs would have led to persistently higher inflation since around 2014. In the second quarter of this year, owner-occupied housing would have contributed between 0.4 and 0.5 percentage points to a new augmented inflation index. The second implication is that as part of our proportionality assessment, we need to choose and calibrate our policy instruments in a way that secures the achievement of our mandate while minimizing negative side effects. And at the current juncture, it is likely that the large stock of acquired assets, in conjunction with our strong forward guidance on policy rates, will prevent an unwarranted tightening of long-term rates once net asset purchases have been terminated. From today's perspective, this can be expected to happen in March 2022 in the case of net asset purchases under the PEP, while the pace and duration of our net asset purchases under our regular asset purchase program will, of course, depend on a thorough reassessment of the medium-term inflation outlook. By gradually shifting the policy mix away from net asset purchases, we can prevent the distributional footprint of our measures from increasing and at the same time mitigate financial stability risks. And by ending net asset purchases before raising policy rates, we signal that we are not willingly accepting losses on our balance sheet that would ultimately lead to losses to the average taxpayer. Our forward guidance ensures that we will not respond hastily to rising inflation rates. We recognize that current high inflation has a particularly concerning effect on the incomes of households at the lower end of the income distribution. However, monetary policy cannot mitigate short-term spikes in inflation, and our efforts are therefore focused on assessing how persistent current price pressures will ultimately be. And at our last policy meeting, we therefore concluded that there are good reasons to believe that euro area inflation will decline visibly over the course of next year and will gradually fall back below our target of 2% in the medium term, meaning that the conditions for raising interest rates, as set out in our revised forward guidance, are very unlikely to be met next year. Prematurely raising policy rates in response to a temporary inflation surge would hurt households with low incomes the most, as it would harm their employment opportunities. Nonetheless, significant uncertainty remains as to how persistent some of the current price pressures will prove to be. And therefore, of course, we continue to carefully monitor inflationary developments in the euro area. Thank you.
Thanks a lot, Isabel. And now we hear from Lenny Liang.
Hi. Thank you, Gita, for organizing it. Thank you to the conference organizers for inviting me today. So on this topic, I want to start with the good news that macro policymakers are now recognizing the potential implications that wealth, income, and social inequality can have on economic growth and welfare. Also, I'm going to offer a perspective from Treasury, maybe a fiscal and political perspectives. Though I'm a novice at this, I've spent many more years at the central bank as more of a technocrat than from the Treasury. Supporting a more equitable and socially inclusive recovery from the pandemic has been a core priority of this administration and the Treasury Department. We know the economic impact of the pandemic fell most severely on lower income communities and households, which were disproportionately often in the frontline service jobs. But it's also a longer term priority. President Biden issued an executive order on the first day to advance social equity to try to close gaps in wages, housing, and lending opportunities, and in access to higher education. It cited estimates that closing such gaps could add $5 trillion to GDP in 5 years. So that is not a trivial amount, it is substantial. On the view of whether monetary policy should consider social inequalities, my views are broadly consistent with generally the economics profession, something that Gita represented earlier. Monetary policy is a blunt tool aimed first and foremost at price stability. In the US, maximum employment is added, so there's already a dual mandate. In general, that hasn't caused conflicts, but already the Fed is tasked with achieving two objectives with basically one tool. That's not to say that monetary policymakers can ignore the economic impacts of monetary policy on inequality. First, we shouldn't lose sight of the fact that price stability, its core mandate, is actually part of the social contract. Inflation is very regressive. I think that's first and foremost. Second, central banks certainly have the responsibility to consider the effects of their policies on inequality. Central banks have a very valuable franchise as the producers of high quality data, information, analysis, and I think they have a responsibility to improve the public discourse in this area. There is the additional question of whether monetary policy leads to greater inequality. My reading of the research is that this link is indirect, a bit tenuous. Of course, asset prices raise, low rates increase asset prices, but for all the other reasons, the channels that Gita represented, generally the net effect on inequality is hard to determine. But there is a potential link. Preemptive policies to reduce inflation work by slowing aggregate demand. That's how monetary policy works. And it's documented that some of these communities and individuals are going to be more vulnerable to slowdowns and to recessions. Isabel's charts were exactly that. And they are the first to lose jobs when growth slows. They are the last to be rehired, and they may have greater difficulty in accessing credit in downturns. And if these patterns are systematic, it seems they could, over long periods of time, reduce the accumulation of wealth and human capital of the most vulnerable. And so these effects could be there. They may be hard to find in the aggregate data, either because they're indirect, they take a long time, they're difficult to identify. But I do think it's very important for central banks to be developing a better understanding of these issues and to be sharing that with the public and improving the public discourse. That said, it's still a separate issue if monetary policy is the most appropriate and effective tool. And I think here there are very strong parallels to financial stability issues. It is clear, at least to me, that monetary policy directly affects financial stability. It affects the probability of a crisis through financial conditions and credit growth. And loose conditions coupled with rapid credit growth, we know are a pretty good indicator of a financial crisis. And they can increase risk to growth, downside risk to growth. Yet even in that situation, unless price stability is jeopardized, policymakers' first option is probably not monetary policy. Rather, a more effective approach would be financial macroprudential policies targeted directly to reducing the probability of a crisis and its conditional impact. I think the parallels to social inequality here are strong. More promising, I think, then are, instead of monetary policy, are some macroprudential policies, because they, in terms of thinking about social inequality, policies like LTVs, et cetera. I hope to say, I'll stop here and hope to say a little bit more later about some of the distributional effects of those kinds of policies. So thank you.
Thanks, Nellie. And now we hear from Roger Ferguson. Roger, I think you're muted.
Thank you. I thought I'd unmuted myself after 24 months of doing this. One might have imagined that he'd be naturally looking there. Anyway, thank you very much. A pleasure to be on this panel, and a pleasure to see our friends and colleagues of longstanding. Very, very important discussion. So let me build on what has been said by emphasizing a few things, and then maybe talking about recent experiences here in the United States. So let me emphasize the points that Isabel and Nellie have talked about, which is the research has shown, and I agree with it completely, a number of points. One is we need to start with the fact that the fundamental mandate for all central banks and the use of monetary policy is around price stability. And Isabel started at a very important point, which is that inflation is perhaps one of the most regressive taxes in almost all of our societies. I recalled when I was joining the Fed now, 1997, testifying to this point, and particularly speaking to other African Americans as to why it was very important to have a central bank that was vigilant around inflation. And so we need to continue to communicate that message. Having said that, we go forward to the next points, and I think Isabel put her finger on it, as did Nellie, which is when we get into recession, the individuals who are most likely harmed tend to be those at the lower wage scales. And similarly, when you think about the transmission mechanisms, as have been discussed, asset prices tend to be disproportionately, by definition, beneficial to those who are wealthier because they obviously control more assets. Here in the U.S., it also turns out that wealthier individuals and our white citizens have a much larger portion of home ownership than do African Americans and Hispanics. And so we know there are potential social impacts of the kinds of distribution mechanisms or transmission mechanisms that we've talked about. So that's some of the basic facts, simply reinforcing what you've heard already. Having said that, we've also had some recent experience in the U.S. over the last 10 years or so that shows that a central bank with a dual mandate, if it is confronting a situation where inflation is relatively flat, and the Phillips curve, as you know, is relatively flat, allows that central bank to, quote, run the economy hot in order to increase labor force participation, bring in marginal workers who often tend to be, at least in the United States, minority and women workers who tend to have lower salary. And so while we do not think of inequality or social dynamics as being the primary focus of monetary policy, I do not think that it should be. We've had a recent experience here in the US until this crisis that has shown, in a situation in which you have a dual mandate and inflation is well contained, a central bank under a bold leader, such as we've had with Janet Yellen and Jay Powell, can run an experiment that results in perhaps increasing the possibilities of leveling out some of these inequalities. And so we should leave that as at least a real world experiment that does not suggest that we should change the way we think about monetary policy, but nor should we say that monetary policy has no effect on current and future prospects for income and wealth inequality. The second point I'd make is we have now another experiment which shows the other side of this, and again works through the question of picking up the economy in a way that brings jobs back equitably across society. So here in the US, we're struggling with a relatively low labor force participation rate, but that is very uneven. So the labor force participation rate for minority males has dropped quite significantly. That for women has also been very, very low. So the most recent measure for labor force participation rate for women remains stuck at around 57%, which is the lowest level in over 30 years versus about 70% for men. And the labor force participation rate for African American men is 4 points lower than white men, at about 66% versus 70%. And why is that important? For reasons that all of you understand, which is individuals being out of the labor force are likely to lose the skills that are necessary to compete effectively for jobs going forward. This is particularly challenging when you come to the income inequality question, because it is still recognized here in the US at least, that women earn somewhere around 79 to 80 cents for every dollar that the male workers earn. And for African American males, it's not much better versus white males. So that clearly suggests that we have a challenge here of both getting the economy going again, but also determining, the central bank will have to determine whether I can once again run the experiment of attempting to run the economy a little hotter than one might have imagined in a period when inflation might be picking up. So I think there is a bit of a challenge and dilemma for the central banks, at least in the US, going forward. Let me broaden my comments by saying two other things very quickly. We're talking about monetary policy, but obviously central banks play other roles, at least here in the US and other places. Nellie put her finger on some of those. In the United States, the central bank is also responsible for some elements of bank supervision and regulation, which I think should be done with an eye towards thinking about equitable distribution of financial capabilities. And I know that other societies, having spent some time talking to the individuals in the Bank of England, the Bank of Canada, et cetera, the question of financial inclusion becomes a very important topic more broadly, including things such as access to the payment systems, particularly newer payment technologies. And finally, I close with the last point I'd make in this space, which is all central banks, I think, have an interest in increasing the level of financial literacy in their own economies. And we do know that, at least in the US, financial literacy is, again, much lower in minorities than it is in our white population. And we know there's a high correlation between the level of financial literacy and the ability to manage debt, to save for retirement, to understand how to invest wisely. And so we should broaden our aperture just a little bit while we're talking primarily about monetary policy, to think about the other roles that central banks play in society and how those could potentially have a beneficial effect in ameliorating to some degree the wealth and income inequality that has become a feature of many economies over the last 2 decades. Thank you very much.
Thank you, Roger. And now we have Andrew Bailey. Andrew.
Thank you, Geeta, and thank you for inviting me to participate in this session, which is both fascinating in subject and actually with such distinguished and interesting colleagues. I was going to start by just making a point about the evolution of inequality in the UK, which is, I think, quite interesting and quite relevant, certainly to our situation. And it's this, aggregate inequality, certainly measured, I think, both in wealth and income terms, increased during the 1980s, but actually has not changed hugely, really, since the early 1990s. However, there is quite a lot going on when you look below that. One of the things that I always find most interesting about it and most probably relevant to this debate is that intergenerational inequality has certainly increased over time. There's a study done in the UK quite often, which takes cuts the population up by deciles in terms of the decade in which people were born. And if I remember rightly, I think it says that the generation born in the 1980s is the first one since the Second World War to be less well off than its predecessor, both in terms of income, asset ownership, house ownership, and that's therefore quite a big change from what I call sort of the post-war model. But that doesn't show up in aggregate inequality, interestingly, but it does have quite a lot to do, certainly, with asset ownership. The second thing I think, as colleagues have said, is that because this question does depend on what monetary policy objective a central bank has. In the case of the Bank of England, we don't have a dual mandate in the same way. We have a single inflation price stability mandate, which is interpreted as an inflation target. The precise language is, and this is important because it's hierarchical, is that it's price stability and subject to that, in essence, supporting other objectives of the government. Incidentally, that's how climate change has come in. It's subject to that. One of those other objectives of the government is defined as climate change as of relevance to the Bank of England. Now, actually, there isn't an inequality policy in there, or an inequality policy in there, I should say, probably, at the moment. So that doesn't feature in there. What I would say, turning to monetary policy in sort of practice, is that I agree with colleagues that I think certainly the pressure, or certainly the commentary, and including from politicians, some politicians, on monetary policy inequality has increased substantially in the last decade, which I think is associated particularly with the use of quantitative easing and asset purchases. It's not a very well focused commentary, I would say, which I'll come on to in a moment, but it certainly has increased. Now, I would, as Isabel was saying, I would separate out here financial assets and housing assets. I think they are different cases in terms of our experience of how, in a sense, it plays out. It's obviously the case that in both cases they tend to benefit. The increase in the value of those benefits, those who are more wealthy. However, it does seem to me that the point that has to be made in response is that asset values are part of the monetary transmission mechanism. In the case of quantitative easing, they're arguably more so part of them, more prominently part of the monetary transmission mechanism. It would be easy to stop there and say, well, therefore we can observe, in a sense, what's happened to asset values, who owns assets, and then conclude. I think the really challenging thing, which isn't done, is to say, to judge that, we need to know what the counterfactual would be. What would be the outcome in the absence of that policy choice? And one of the points we have certainly made to Parliament and to those politicians who've said, well, you're increasing inequality, is to say, well, we do really believe that in the absence of the policies used, unemployment would have been higher. And that's a point that I think possibly in the sort of in some of the debates, because of possibly the subtlety in those debates about the use of a counterfactual, this point about what is the alternative level of unemployment, and therefore what's the implication of that for inequality, doesn't get a lot of attention, and it's sometimes I think quite hard to get that point properly across. Now the final point I would make is really, I think, a couple of points Nelly made actually. Interestingly, I think the question, particularly in relation to housing assets, is in some ways posed more sharply in the arena of financial stability policy than it is monetary policy for us. We have got in our financial stability work, in our financial policy committee, we adopted so-called housing tools back in 2014. So we've had them in place for 7 years, currently reviewing them. We review them quite often, actually, about every 2 years. And the reason we do is because I think for central banks, the reason that this is important and does, in a sense, directly get to questions that people perceive to be about equality, is that for a central bank, I think adopting a housing tool, and we have two. One is to limit the number of mortgages above a certain loan-to-income ratio that each lender gives. It doesn't say they can't, but it's taken a sort of a threshold value and say there's a certain number of mortgages you will want to grant above that loan-to-income ratio, but historically, if you get concentrated in that area, it will have bad outcomes for financial stability, and it will also have bad macroeconomic outcomes. The second one is an affordability tool, which essentially is for each borrower is a stressed interest rate test. But the reason I make this point is that I think those tools uniquely for central bank, for us as a central bank anyway, really impinge directly individually on members of the public. So I think they directly associate the central bank in ways that monetary policy seems rather more general. People comment on interest rates, People observe, the impact in a general sense, but it doesn't have quite the same impact as can I buy the house I want to buy or can't I, as a result of a policy that the central bank's adopted. So it's interesting to my mind, just to finish, that I think in our case, certainly, I think while there is commentary around monetary policy and inequality, and it's quite a lively debate in some circles, but not in a generalized sense. It can at times, particularly for first-time house buyers in this country, and we have, Isabel was making the point about home ownership. We have quite a strong, home ownership, where it's quite high. It can become quite pointed. I'll stop there, Peter. Thanks.
Thank you, Andrew. We have a second topic to get to, but I'm going to ask a couple of questions, maybe a little more pointedly. Isabel, if I may come to you, I think what the discussion has shown is that to some extent there are still the traditional arguments that remain on what monetary policy can and cannot do, and it is restricted in the kind of instruments it has. It has an effect on asset prices, it has an effect on housing prices, and through that it has an effect on inequality. But on the other hand, it is the tool that's needed to prevent severe recessions, create more jobs, and they end up benefiting at the lower end. But it is what's gotten a lot of attention. I think over the last decade, the link between monetary policy and inequality, and in the negative sense, has gotten a lot of heated attention. So I know that the ECB, of course, did a recent review of their monetary policy framework. It would be great if you could share your views on how these concerns on the distributional consequences of monetary policy entered that review. Yep, just very briefly. Thank you. And I guess where you arrived at after that.
Thank you very much, Geeta. So let me stress first that, of course, monetary policy is not the primary tool to deal with inequality. I mean, I think that's obvious for everyone. And one of the reasons for that is that a large part of inequality is, of course, driven by these long-term structural trends, and that is something that monetary policy cannot deal with. But one aspect that was very present in our review, and which is actually related not only to inequality, but also to financial stability and to climate change, is the question. And so actually there are two questions. So the first is also mentioned by Andrew. How do we deal with our, what we call the secondary mandate, which is similar to what Andrew explained, that we have this clear lexicographic ordering with price stability first, and then as a secondary objective, we're supposed to support the general EU policies, which includes things like environmental protection. It also includes things like social cohesion. So inequality seems to be a part of that. That's one thing. The second thing is, how do we deal with the side effects of our monetary policy measures? And again, that can be financial stability, that can be distributional effects, and so on. So on the first point, I think what is clear is that the legal, so the treaty basically obliges us that if we have the choice between different types of measures, then, and they have basically the same effect on our monetary policy stance, let's say, then we are supposed to use the instrument that is better in line with the EU general policies. And I think it's important to stress that monetary policy is not like a one-dimensional thing that you can do a bit more or you do a bit less, but we have many different tools, and different tools have different implications for financial stability, for on inequality, and so on. And this leads me directly to the second point. This is where also our proportionality analysis comes in, which is the point that, and this is really deeply embedded in our strategy, that we say whatever monetary policy decision we take, we always have to make sure that the benefits are greater than the costs. And the costs, they do include things like distributional effects, financial stability, and so on. And therefore, I would say we cannot simply say we have nothing to do with that. And actually, in our ECB Listens events, I mean, there were basically two topics coming up most, and this was climate change and this was house prices. And simply to say we ignore all of that because this is somebody else's job, I think is not enough. I mean, that is not enough. We really risk also losing the trust of the people if we simply say, oh, this is none of our business, even though we know that our policies have an impact on that. So let me stop here.
Mm-hmm.
Thanks, Isabel. Andrew, you want to jump in?
Just say briefly, because I think it's an interesting point Isabel made about the evolution, certainly as I see it, of this sort of the hierarchical objectives. Because I think when we set out nearly 25 years ago now on this route, that was interpreted very much as a way to handle the dual mandate in a sort of an updated way. So it was really about price stability and subject to that growth. In other words, and the way the Bank of England explained it was, if we get price stability right, we'll support growth. End of story, really. Now, it's moved on a long way in the last 25 years, and it's interesting to reflect on that because, as Isabel said, I think now, I think still that narrative is still there, but it's much more about specific policies. If you can sort price stability out, can you then do some other, some things that will be consistent with that, of which climate change would be one, but aspects of inequality could be another. So it has moved on quite a long way, I think, in the last 25 years. Thanks.
Roger, do you want to come in?
Could I comment on the other part of what Isabel said, which is very much on my mind, which is central banks are, in all of our countries and jurisdictions, highly powerful, rather mysterious, unelected officials, and in which trust is critical. And part of that trust, to Isabel's really good point, is a combination of communication with something that's going to sound funny in central bank community, but empathy. So a recognition that our policies actually do have distributional impacts and that we take that into consideration is important. Here in the US, obviously, because of the very explicit dual mandate, how one thinks about those trade-offs between inflation and unemployment and the implications are very, very important. And so I do think, and to Andrew's point, I don't know how hard it is to make the counterfactual. I think at least from, Nelly may disagree with me here, I think from the US, the understanding that, we have to bring economies back to growth in order to create jobs is pretty clear. But I really want to reinforce Isabel's really good point that so much of this conversation has got to be driven by a discussion around or recognition that trust is really important here. And while we cannot use monetary policy to solve social problems, I don't think societies want to see some of their most important policymakers appear to be completely indifferent to these issues. And so I think that's an important component that Isabel has added to the mix.
Thanks, Roger. I want to now go to Nelly. You left us hanging with the remark that financial regulations might have a role to play in addressing issues of inequality and in macroprudential regulations. So tell us about it. That would be great.
Okay, thanks. Thanks for that. So I think unlike monetary policy, as I said, I think actually financial regulatory and financial stability policies can actually incorporate and reduce social and economic inequality. There's a number of examples, maybe is the best way to think about this, especially if they can work with fiscal. And even a central bank with financial regulations can interact with fiscal. So one example that I point to is directing resources to increase investment in underserved communities, businesses, individuals that can promote financial inclusion and social equity. So in the US, we have financial institutions such as community CDFIs, community development financial institutions, and minority development institutions that are lending programs to provide credit and even technical assistance to underserved communities. So these get credit. They are incentivized by current financial regulations, and they're coupled with fiscal resources. And these programs have been around for decades, and they have proven ways of supporting local communities. So that's one example where financial regulations can help. On macroprudential policy, which is a newer development, and central banks are given the task of, because of their broad perspective on the economy and financial system, are given this task. There's like this new growing area of research that I find very interesting. So I think we talked about the role of loan to value ratios, or loan to income ratios, or debt service to income ratio requirements that are used, as we all know, as a macroprudential tool. Bank of England has used some form of this. Of course, this is used has been used a lot because many crises have been associated with house price booms. And so this is an area that has been used. But not surprisingly, if you impose loan to income ratios or debt service to income ratios, when they're implemented, it will have an effect on there will be a distributional effect. And there's some growing research in the last couple of years that, of course, you're going to shift lending from lower income households to higher income households when you impose these. There's some additional research that shows it can also reduce differences in price gains across areas. So it's reducing the geographic dispersion in house prices. Now, the point is, it is reducing the feedback loop between high credit and house prices, which is financial stability enhancing. But once you look below and you see the shifts across income and across regions, that's important information. That's new information that can be brought to bear into discussions of macroprudential policies. There's some additional work, which looks at the time dimension of macroprudential policies. For example, implementing an LTI, a loan to income ratio. It should reduce the buildup of systemic risk and reduce the cost of a crisis if it were occurring. So this is like that preemptive element. In that sense, it suggests it could increase inequality in the buildup phase because lower income households have fewer opportunities for home ownership. That's a buildup of inequality. But it could reduce inequality in the bust phase when there's a negative adverse shock, because those vulnerable households would be shielded from the negative wealth effect of price drops. So some interesting research has tried to simulate this with these sort of, VAR models or Bayesian VAR models to sort of the net effect. What's the net effect on inequality if you keep some out from home ownership, but shield them from the negative effects? And one paper from the ECB staff of researchers, looked at it across 4 countries. And of course, it's going to depend, but it's going to depend on things like the sensitivity of unemployment to this credit supply shock or the sensitivity of house prices. But it's a great framework. It's like it pins down the things you care about and you can evaluate, and every country can take this on as they're thinking about implementing macroprudential policies. So I think this is very, to me, exciting way to integrate financial policies and social inclusion policies and equality policies, just setting the stage. And so I encourage this conference and all the researchers out there to be doing more of this. These are very, very time relevant questions to policymakers currently.
Thank you, Nellie. I think we could go on this just one topic, but we have a second one, which is on the diversity and inclusion problem in the economics profession. So central banks are some of the largest employers of economics professionals. So in that sense, they have a very big footprint in the profession, and therefore they can influence diversity and inclusion in the field of economics. So the question that I would pose to you is, what role do you think central banks have in addressing diversity, equity, and inclusion at your institutions and within the economics and finance professions more generally? Let me just share a couple of points from the International Monetary Fund, which is another institution that hires a large number of economists. As of 2019, when we had the annual report, the share of women economists among all IMF economists is around 30%. Now that has increased over the years from 26% in 2011, so the direction is right. But of course, we're well short of the goals. Gender diversity is a bigger problem once we look at senior management roles among economists. And again, it falls short of the 50% target. We're currently at about 28% or in terms of women being economists in senior and managerial roles. And of course, there is the question not just of gender, but more generally of diversity from different regions and different races that we need to address. Now, there are actions that are being taken at the IMF in terms of internal staff training, targeted outreach and recruitment, institutionalized diversity office tracking the data on diversity in scores and so on. So there's a lot of work being done, but there is a lot more that needs to be done. So let me first start by going around, and I guess I'm doing this now in reverse order with Andrew. Andrew, why don't you come in and share your views on this question? Again, 5 minutes.
Thanks, Geeta. It's a very important, I think, question. Certainly it's a very important question for us at the Bank of England. And although we don't really quite classify our staff as either economists or not economists in quite the same way, so I can't quote you a figure of economists. I mean, our general figures are not far off the numbers that you're quoting for the IMF. So I think we've got the same challenge. I mean, the first thing that I think is important to stress is that it's important, I think, as central banks in our broader contribution to the economics profession, as you say, to say that we will not accept that it's a sort of forever law of economics that is sort of mainly done by men. There is no good reason for that. It may have been true in the past. There may be all sorts of theories on why it was true in the past, but it cannot be a good argument going forwards. But to do that, of course, we have to play our part in the profession more broadly. I think, helping universities and schools to get to the bottom of what it is that causes people to prefer, one subject over another. But the reason I say that is that from the point of view of the Bank of England, I always, have two strong principles that I operate by the Bank of England, and I would say for any public policy institution, actually, and of course it actually goes beyond public policy institutions. First, we serve the nation that we are the central bank of, and it's important that we bear, a sufficient resemblance to the nation that we serve. Otherwise, people will quite rightly say to us, well, you don't really represent the nation you serve, and how can you represent the nation you serve in that way if you don't really bear a sufficient likeness to the nation that you serve? It doesn't have to be exact. It's not sort of down to the sort of the sort of second decimal, but it has to be sufficient for people to look at the Bank of England. All people in this country to look at the Bank of England and say, I think this is an institution that will understand, my situation, and will understand the economy through, different lenses. That's important. The second thing is that I think it's a better institution. It's a better institution for people to work in when it's diverse. I always say, I don't want to work in institutions full of people like me. And I think that is an important point. And we've been working hard at this in the Bank of England, but honestly, and we published last year a review that was done of particularly ethnic diversity in the Bank of England, which I started when I became governor because I knew that we had to make more progress. Relatively, we've made more progress on gender. Haven't got to where we need to get to, by the way, but relatively, we've made more progress. And it concerns me that we had far more to do on the gender front and we were not making the progress. Now, I think, first of all, we have to then have that constantly in mind. It's hard, we don't have enough role models, frankly, and I think it is important to have role models because I think, people who, young people who join institutions, I think reasonably ask themselves the question, do people like me get on in this place? Can I observe that people like me get on in this place? Now, again, I think we've made more progress on gender than on diversity in the Bank of England. So we've not got to where we need to get on gender, don't get me wrong, but we've made more progress. And so we have got to make a lot more progress. But it raises really hard questions. It raises questions about when you've got a discipline which is not evenly, not representative, you often, when you're recruiting, get left with very uncomfortable choices. I think, we all, stand by the principle that we always recruit the best candidate. There is, of course, a very interesting question about how you define the term best candidate. I accept that, and there's some quite lively challenge in the Bank of England on that, and quite rightly. But what I do also say to people is what we've got to aim for is a world and an environment in which the best candidates in future are more diverse. That will take time and a load of effort and a load of work. We've got to commit to it. So I will stop there, Gita, if you don't mind.
Thanks, Andrew. Roger?
Well, thanks again. And let me pick up with some points that Andrew had made and from also the earlier part. So the question is a number of questions. First, two questions, why and how. So why should central banks care about this topic of diversity and inclusion? I think Andrew's put his finger on it, and it builds on something that Isabel said as well, which is we're very powerful, unelected organizations built ultimately around trust and confidence, and the ability, as Andrew said, to roughly represent our societies and be seen to be sensitive to all the components of society is really very important. The Federal Reserve System itself was structured geographically to make sure in this massive country that all regions were represented. And indeed, the reserve banks have three classes of directors, as Nellie knows, in part to create a kind of diversity of profession. And so, at least for this institution, I shouldn't say this, I don't speak for the Fed anymore, but for that institution, concepts of diversity were already built into the initial charter, so that it would be widely perceived to be representative in the ways that people in 1918 thought were important, and we should still carry that forward. So how should we do that? 3 or 4 points come to mind. One has been touched upon already by Nellie and others, which is doing phenomenal research in this space. And fortunately here in the US, with our various reserve banks, we see a great deal of research around diversity and inclusion, et cetera, and the benefits that we believe to be there, and validating the kinds of research that Nellie just talked about. And I think that's really quite important. The second, Gita, you put your finger on it. Central banks are great hirers of economic talent, and being very explicit about looking for diversity because we think it makes for better central bank decision making is very important. And here, if Mary Daly, who's the president of the San Francisco Fed, were on, she would tell her story. I think now you know her story quite well. She did not go to one of our leading economics institutions. And when she was hired as a junior researcher at the San Francisco Fed, it was a highly risky decision. When she questioned the person who hired her about why it was that he was willing, or why were there so few people from her lesser known economics department, he said very simply, because if I go and hire someone from Harvard, Yale, MIT, et cetera, and they fail, it's not my fault. Obviously we went to the best places, and we happen to have someone who didn't work. Here in the US, if you go to a second tier school, hire them for the central bank and it doesn't work, guess whose fault it is? why did you even look? And so, Mary, I think, would be very passionate about the point that you made, Andrew, of, well, what risks do we take in the hiring process? And would probably encourage us to take even more risks in the hiring process than we do. I would say, to give my friends at the Fed some credit, they are now involved in a partnering across several of the central banks with a group called the SADI Initiative, not known to most of you, but it is a group of young African-American women named after the first African-American woman to get a PhD at a major U.S. institution in economics, apparently. And they're looking to mentor and bring these young women, African-American women, if possible, into the system, the Federal Reserve System. So actions can be taken in hiring. Third, playing in the how, and again, we've done it here in the U.S. maybe, showing the model, is the bully pulpit of central banking. And two of our former Fed chairs have gone on to be the presidents of the American Economics Association and have made diversity in the profession a linchpin of their platforms, both Ben Bernanke and Janet Yellen. So I think there is room for us not just to research, not just to work on the hiring, but also to drive forward the conversation with what we in the U.S. would probably bully pulpit. So let me stop there and turn it over to you, Gita. Thank you.
Thanks, Roger. Nelly?
Okay. So maybe I'll just broaden again a little bit to government-wide and thinking about roles in terms of promoting diversity in the economics profession. So let me just start with a couple of data points. Some previous colleagues of mine at Brookings had done a survey using government-wide data on the employment of PhD economists in the US government and compared it to academia. So just a couple of points. First, the government employs, in 2018, 2,111 PhD economists, which is a big number. I don't think it includes the IMF. So the Fed system was about a third of it, a little bit more than a third, which suggested broad government had a lot of economists. And the counterpart was about 5,000 PhD economists at academic institutions. Government is a big employer. Its policies have a big effect. If you compare government to academia, government-wide, about 30% were women. That sounds similar. In academia, it's about 23% based on a C-SWIP survey. And in terms of minorities, government is about 24%. That includes Asian, Hispanic, Black, and others. And academia are about 21%. So government's slightly better in terms of greater proportions than academia, but clearly both are underrepresented by Blacks, Hispanics, and women. So I think it's undeniable that economics as a profession has room to improve. I really like Andrew's statement, an expression of our goal is to have the best candidate, the candidate pool, the best candidates are more diverse. That's our goal, is to make the pool of the best candidates more diverse. So I guess in terms of, so I think those are all useful facts. You can collect, all the data are there in a spreadsheet too to look at. What to do about it is, just a substantial problem. Looking at the pipeline, it looks like it's better. Like if you look at undergrads, if you look at research assistants, those who might pursue professional degrees in economics, it's a little better, but it's not, and it's improving, but it's not quite there yet. So while women represent 55% of undergraduate degrees, they represent only about a third of those with economics undergraduate degrees. So we have, I think, some work to do And the reason this is important, one, why is this diversity important? One is just there's a pool of wasted talent and resources, of underutilized resources. Two, I think lack of diversity means lack of diverse research. I think there's this, there's this common view that we know a lot more about men's health outcomes than women's health outcomes, based on the previous research. And I think women tend to certain kinds of research and men tend to others, and we could improve the state of knowledge by more diversity. And I think there's a bit more of, there's just a general fairness objective, which is a loaded word, but I kind of just view it as improving the overall work environment. And so those are important things. I think all the institutions are making great efforts to try to improve diversity. There's been a little bit of evidence that mentorship can be helpful. There's some evidence out of this mentorship program with the C-SWEP where it's very time intensive, but just working with younger faculty improves publication rates, advancement in the future. Those kinds of things are very promising. But not that I have a straight answer to this, but it is recognizing the issue is at least half the problem, at least half the solution. Thanks.
Thank you, Nelly. Isabel.
Thank you very much, Geeta. So I've been thinking about this topic a lot already in my previous life in academia. I mean, if I look at my own education, so at my German university, I did not have a single female professor in my entire education. When I became a professor at the University of Bonn, I was the first female full professor at University of Bonn. It's unbelievable, and that was like 5 years ago, right? So, so that's actually, it's quite. So there is a problem in the profession, and there's of course now there is a lot of research on that. I mean, in academia, there's this issue of the leaky pipeline and so on, and I think we've learned a lot about what is behind that. And I think one of the main findings is that one of the reasons for the underrepresentation of women in economics is that there are either institutional or psychological barriers. So there can be cognitive biases, and there can be like institutional structures which favor men, even though that's not intended, right? So it's not really so much about discrimination. It's much more about such barriers. And for us as central banks, of course, this matters greatly because I mean the pool for our recruitment, of course, comes from the university. So we have a keen interest in them solving this issue. So when I came to the ECB, so of course, if you look at the leadership of the ECB since its start, within the group of more than 60 governors of the national central banks, there was a single woman out of more than 60. In the executive board, it's a bit better. So there were 20-something board members, and 5 of them were women. And as you know, now for the first time, there are 2 women in the executive board, and the first, of course, the first female president. The problem is that if the leadership is, if there are so few women, that can give rise to self-fulfilling expectations, in the sense that people tend to think if women are not there, there has to be a reason for that. So maybe they're just not good at that, right? And at the same time, of course, there are no role models for those who come, who are just starting their career. And so at the ECB, there was very interesting work done, as you also discussed about the IMF, Geeta, on what is the reason for the underrepresentation of women at the ECB. And actually, one of the authors of the study, Anna Lamo, is actually in the audience. So let me tell you what they found out. So what they found out is that there is at the ECB, or that there was actually a big gender wage gap. So big gap between men and women in wages. And then they discovered that this was due to a promotion gap. So it seems that men were promoted more frequently than women. And then they also found out that that was due to the fact that women were less likely to apply. And then with the gender strategy that was introduced a couple of years ago, the ECB started to encourage women to apply. And already that changed the ratios quite substantially. And of course, Christine Lagarde has put this issue on the top of her agenda, and she has pushed the diversity agenda very, very hard. And we now have an even more ambitious gender strategy, and also more general diversity strategy. And with respect to gender, we now have these hiring and promotion targets of 50%. And I can tell you, it's actually working very well so far. So what I've seen since I've been at the ECB is that there are so many highly qualified women that this has never been an issue. And it has never been an issue that we said, oh, we now have to hire a woman, but she is actually worse than the male candidate. There are plenty of very well-suited women. And I think we are making great progress there. And of course, there are a number of additional measures, like Edward also mentioned, by some of you, like mentoring. We have scholarships specifically for women. But I think we can move forward. I agree with Nelly, there's a long way to go still. But I mean, in principle, I think we know what we have to do, and we should just do it.
Thanks, Isabel. I think I completely agree with you that I think we know what needs to be done. We know all the benefits to the world from having greater diversity and inclusion, and so I think it's about getting the work done. Let me come to Andrew with a question. Andrew, you said that one of the problems, if I may just paraphrase, was a non-diverse pipeline in terms, and I think several others have brought it up too. So I guess the question is, how do we increase this pipeline? As we know, and as Nelly mentioned, that once you start getting to at least the PhD levels, you know, it's about 25% of the students are women. You found women dropping off before that. Now, one of the arguments that you hear about why women may not be going into a PhD program or even a master's is because they associate economics with, you know, Andrew Bailey talking about raising or cutting interest rates and about monetary policy more generally. And it feels less appealing than, you know, talking about some of the other issues that they care about, climate specifically, or you know, poverty directly. And so there is a sense in which it's that, at least in surveys, that what comes across is that economics is very monodimensional. What we see is suited men talking about macro policies in very abstract senses, and that doesn't sound that exciting. So I guess, what would you say to them, and how would you encourage them to get into the field?
Well, it's tricky, isn't it? Because I'm obviously not representative, because I find the whole thing fascinating. And I think I think we do have. You're right, Gita. We do have to do more. I think we are doing more, but I think we have to do more to make our world sort of come alive, in the sense of make it, you know, understandable to people, and to all sorts. I mean, to a whole range of people. That's important. It's important, obviously. Look, to start with, it's important because, you know, the effectiveness of policy will be better if it's better understood. So actually, let's start with that point, which is quite basic, really, but important. And then I think we have to do more to say, look, it really is interesting, and it does make a difference. I mean, I do look at the last, you know, nearly 2 years now, and okay, monetary policy is, you know, only part of the story, so not the biggest part of the story in terms of the response. But certainly, speaking for the UK, but I think I can sort of, read it across to other countries. I think economic policy making has made a huge difference in this crisis. I look at how bad this could have been, and look at the things that we've done. And by the way, the things that we did before it to, in a sense, guard against these sorts of events. I mean, I've said a lot of people. I mean, if we'd had a pandemic 20 years ago, 15, 20 years ago, we'd have had a banking crisis on our hands as well, probably because of the weakness of the system. So I think there's a lot to be said for saying, look, this stuff, these things that we do really do matter. But we have to do that in a way that, as you rightly say, doesn't seem boring and rather one-dimensional. But I think it is important, as policymakers, that we do go out there, and probably that we take a few sort of greater risks in terms of how we communicate things to explain to people it really does matter. And as I say, I think we've got actually quite an interesting example of this in terms of the response to COVID. We've had to make huge responses. We've taken, we've done things that we probably never imagined we would do in the world before. And I think going out and talking to people who are interested in, kids at school, people at universities, and say, this is what we had to do, this is what we did. And, it really is important, and it really is fascinating. Says he who is extremely biased, obviously.
Thank you. Roger, I was wondering if you wanted to come in and share your views on how to increase the pipeline.
Well, first, all of us are biased, right? Because I fell in love with economics when I was 15. Now, part of that, though, is how to increase the pipeline. The reason I fell in love with economics had something to do with financial literacy at home. But in 1966, when I was 15, the first Black governor of the Fed was nominated. And so this whole question of role modeling, as we say sometimes here, if you can see it, you can be it. I'm sort of the embodiment of that. So, a way, not the only way, to increase the pipeline is for, the three women here, myself, Andrew, all of us, to be out talking about diversity of view and why this is exciting for everybody. Secondly, I think we do need to broaden the ambit of the way we think about economics. So we are representative of, a very important dimension of economics, but hardly the only one. We probably happen to think that, central banking monetary policy is the most important of the various disciplines in economics. But, when I think about what economics is about, is to Andrew's point, it's fundamentally about understanding and solving social problems. And, the second way I think we can increase the pipeline is to simply look at the diversity of who's been recognized as leading economists lately. And it includes people who are, almost all, let's be fair, male, some females, fortunately, but everyone, economic historians, Danny Kahneman, who's basically a sociologist, psychologist, I guess. Recent winners doing things on experimental economics, et cetera. So I think, part of the way to increase the pipeline is to identify the diversity in the profession that already does exist. And I think the third is to think about this dilemma that we have, which is that economics is so heavily associated with mathematics, and what happens around the ability for women and minorities to keep growing in math spills over into other topics. And one of the reasons I was very excited to see, and have been excited to see different kinds of economists winning, is we've lots of recognition, is no longer is economics, to my mind, the sort of the stepchild to applied math. It actually is starting to think much more about its social science origins. And that, I think, will certainly help drive the pool, because I believe one can be a very credible economist without necessarily having been the tippy top of your class and continuing on the various dimensions of calculus. I could be wrong, whenever you may disagree with that, but I do think celebrating different models of being an economist is another obvious way to increase the diversity.
Thanks, Roger. By the way, if there's a participant who would like to ask a question, please raise your hand. We don't have that much time left. We have about 7 minutes. But if you raise your hand, you can have the screen at that time. Let me ask Isabel, you know, you've seen this story happen over some time now. What makes you optimistic that we might actually be on a trajectory where we end up in a good place? And what makes you pessimistic?
So let me first share one thought that I had when I was listening to the others. So actually, I think there is an interesting connection between the second and the first topic. So one of you said that no longer we have at the central banks, we only have like men with dark suits, but we also have a couple of women. At the same time, we are discussing different things at central banks. So suddenly we are discussing things like inequality, climate change. So I leave it open whether that is a correlation or a causality. But in any case, it may actually be that that this makes central banks more attractive also for women, because it is indeed, there is research showing that on average, I mean, women are interested in different things from men. And actually this this shift of topics also in the central banking world may make central banks more attractive. On your question, I must say overall, I'm optimistic because so many things are going on, and I mean there seems to be a clear will to change things, and I've seen that at various places. And I mean it's going slowly, but it's moving in the right direction, and this is what makes me optimistic. Maybe one point, and this related to something that Andrew said, is that of course, in the past, women had kind of fewer chances to succeed, but of course now it's kind of reversing. But that implies that actually young men may sometimes feel that they now have the lower chances to succeed. And for this generation of young men now, I mean, this is also a problem. I mean, we should keep that in mind, that some of them may have the feeling that due to the fact that now everybody is looking at gender issues, they may actually end up being disadvantaged. Probably part of that has to happen in a sense, because otherwise we'll never get to, I mean, we don't need the 50-50, but to a more or less equal representation. But I think that's also something that we have to keep in mind.
Thanks, Isabel. Nelly, would you like to weigh in on this question?
Just one thought. I think the recognition of untapped potential is become just more widespread, and the benefits not just to the economy as well as to society from greater diversity and inclusion is more apparent. I'm optimistic. I don't know, what is the final goal, exact representation of the population in the economist profession. I feel like that's probably not where we're aiming. Economists themselves have self-selected out of the broad pool of the population, but I do like the idea of the best pool of candidates is more diverse than today. I think that's something we can definitely aim for, and that's it.
Raju, did you want to come in? Or Andrew,
No.
on this? On whether you're optimistic and...
Oh, well, I'll come on optimistic. I'm always optimistic. Now, part one. Two, just observing the fact that we've been having this conversation is quite amazing. It's a sign. And secondly, I recall one of my great mentors or friends, Alice Rivlin, describing what it was like when she graduated from Radcliffe, as it was then called, in 1964, 65, trying to get her first job. She had to enter in the back door of a crazy men's club in New York and literally have her be interviewed sitting outside of the women's room, because it was the only place where she could even be interviewed. Now, so is one optimistic? Of course, only because by definition there's been progress, not enough, not fast enough. But the fact that we're even at this level having this discussion says to me that this is a problem that we'll keep chipping away at. So I tend to believe that progress is the natural path for humanity, and it's going to be slow and steady, but I suspect 20 years from now, this conversation, if it occurs, we'll have a very, very different expectation. That's not the same thing as saying 20 weeks from now, of course.
Thanks. Let me bring in, we have Linda Lober. We have just 2 minutes left, but Linda, do you want to ask your question? Thank you.
Yes, I wanted to just say, Roger had brought up a point. I'm Linda Loubert from Morgan State University in Baltimore, Maryland, an HBCU, and I teach economics. And one of the things that I do is I use GIS in teaching economics because it's a technology that brings layers of information to a point of interest, to a point of inequality, to a point of whatever it is that you're trying to maybe fund or whatever. So I think the more that we can bring in, these technological tools into economics and not just be so math driven, can excite more people and just kind of just bring just a multitude of things for us to vision.
Thank you, Linda. Since we're out of time, I'm going to wrap up in the last 60 seconds. This has been a great discussion, on the question of monetary policy and inequality. Of course, I think everybody agrees that inequality is a major issue that needs to be addressed. Monetary policy affects it in complicated ways. And to the extent that while there are multiple instruments, there's only that much monetary policy can do. Inequality needs to be tackled by structural reforms and fiscal policy and the other tools that one has. On the second question, I guess the good news is that everybody's optimistic that we're having this conversation and that we're making progress on this front. I liked what Isabel said, that targets help. So maybe if you're an institution that doesn't have a target, it's a good thing to consider having a target that actually will get you there. And lastly, I was wondering, maybe when you have your meetings of central bankers and you can start the meeting by just saying, well, we recognize that we have very few women in this group. Just take a moment to recognize that we have too few women in this group, and then move on, because that is the fact. That I have been in numerous groups where I'm just the one or the only other woman who is at the table. And it might be good for everybody to pause and say that there's something wrong about this. But thank you so much for your time, and this was a really great conversation. And thanks for everybody who joined to listen in. I'm sorry I could not get to all the questions, but thank you, everyone. Have a great day.
Thanks, Gita.
Thank you.
Thank you very much, Peter.
Bye,
Thanks.
thank you.